Hey there, folks. Welcome back to our weekly economic update. Your go-to source for understanding what's happening in the world of money, markets, and the economy. Whether you're an investor, a curious observer, or just trying to stay informed, we've got you covered with this week's top financial headlines and insights. Let's jump right into the big story of the week: inflation. The US Bureau of Labor Statistics just released the Consumer Price Index (CPI) data for March, and the numbers are offering a bit of good news. According to the report, inflation appears to be slowing, suggesting that the prices we pay for everyday goods and services, from groceries and gas to rent and utilities, aren't rising as quickly as they have in previous months. This is a crucial development for consumers, policymakers, and investors alike. Now, let's break it down a bit further. The CPI rose 0.3% in March, which is a slightly slower pace than February's 0.4% increase. On a year-over-year basis, inflation is now up 3.2%, which is still above the Federal Reserve's target of 2%, but it's moving in the right direction. Core inflation, which strips out volatile food and energy prices, also showed signs of easing. This is especially important, as core inflation is often seen as a better indicator of long-term trends. So, why does this matter? Well, the Federal Reserve pays very close attention to inflation when deciding whether to adjust interest rates. If inflation starts to spike, the Fed may raise rates to slow down economic activity and bring prices under control. Conversely, if inflation is falling or stabilizing, the Fed may decide to pause rate hikes or even consider cutting rates to encourage growth. Right now, these March numbers could give the Fed reason to hold steady for the moment, a cautious but optimistic sign for the months ahead. Of course, inflation isn't the only thing the Fed looks at. Another key factor is the labor market. And this week, we've got encouraging news on that front, too. The latest data on jobless claims, that's the number of people filing for unemployment benefits, shows a decrease, dropping to 216,000 last week. That's down from 222,000 the previous week. And it's a clear sign that fewer people are losing their jobs. This kind of data suggests that the job market remains relatively strong, and more importantly, that people are finding and keeping work. A stable job market is one of the pillars of a healthy economy. When people are employed, they have money to spend, and that consumer spending drives business growth, which in turn supports more hiring. It's a virtuous cycle. Now, let's pivot to something that's always on investors' minds: the stock market, and in particular, the S&P 500. As of this week, the S&P 500 is up nearly 20% since the start of the year. That's a pretty remarkable performance considering the economic headwinds we've been facing, including inflation, geopolitical tensions, and uncertainty around Fed policy. What's driving this market resilience? A few things. First, many companies have reported strong earnings, beating analysts' expectations and showing that they're managing to grow even in a challenging environment. Second, there's growing optimism that the Fed is nearing the end of its rate hiking cycle, which is good news for both businesses and consumers. And third, investor confidence seems to be returning as inflation fears cool off. That said, we're not completely out of the woods yet. There are still risks to keep an eye on: global tensions, energy prices, and of course, any surprises in economic data that could cause the Fed to change course. But overall, the outlook is far more positive than it was this time last year, and the markets are reflecting that cautious optimism. So, what does all of this mean for you? The viewer, the saver, the investor, or just someone trying to understand where things are heading? Well, if you're a consumer, the signs of cooling inflation could mean a little less pressure on your wallet in the coming months. That doesn't mean prices will go back to where they were, but it does mean they may not rise as quickly, giving you a chance to catch your breath. If you're an investor, the market's upward trend might be an opportunity to reassess your portfolio. Are you positioned for growth? Are you diversified enough to handle some short-term bumps? These are good questions to ask right now. And if you're just keeping an eye on the broader economy, this week's update suggests that things are moving, slowly but surely, in the right direction. Inflation is moderating, joblessness is down, and the markets are holding strong. It's not perfect, but it's progress. That wraps it up for this week's economic update. We hope you found this breakdown in the world of finance and economics, and we're here every week to make sure you stay in the loop. If you enjoyed this video, please give it a thumbs up, and don't forget to subscribe to the channel so you never miss an update. Have thoughts or questions about this week's news? Drop them in the comments. We'd love to hear what you think and continue the conversation. Thanks again for tuning in, and remember, stay informed, stay positive, and we'll see you next time.